Okay, so you can all see my bright yellow shirt here. We're about to begin. We will have a couple of polls. So I want you to be sure to just select the answers on those polls. All of the answers as they come in will be anonymous. So no need to worry about, feeling as though you're being watched or anything like that. We just simply want to get a better understanding of who is on the line with us, because as we go over the various types of financing, we want to be sure that it's applicable to where you are. And one of the huge things for us is to meet you where you are and allow for us to give you the most accurate or meaningful and impactful information that we possibly can. So we're going to shoot that out now. Let's go ahead and get started. We'll let the screen load up for us here. 1 second. I think everyone should be able to see the screen. Rasul, does that come through clear on your end?
Yes, sir.
Okay, beautiful, beautiful. Okay, so we're gonna move right along and pull up our first poll for the day. We want to get a really clear understanding of who's on the line. And so the first thing I want to ask is, how long has your business been established? Okay. And so if it's more than one of you, just how long, is it, if it's you, if you have a partner, how long have you guys specifically been generating revenue? And that's what I'm really wanting to hone in on here. Many of us have a company that's established, but we aren't necessarily generating revenue as of yet. And so for the purpose of knowing where you may qualify and which product may be the best product for you, it's important for us to understand how long or what type of financial or revenue history you have. And so if you hold on 1 second, and we're going to shoot that out to you, and that way you can see it. 1 minute here. All right, 1 second. I think that everyone should be able to see that as of right now.
It hasn't popped up yet, Lou.
Has it popped up for you? Okay, 1 second. Let me just go down here and make sure. Not a problem. Okay, let me go back. All right. Polls. All right. So here we go. All right, there we go. There we go.
Yep.
Okay. How long has your business been established? Okay. So we're dealing with quite a, okay, let the numbers roll in here for us. All right. Okay. Good, good, good. So from what I can see here, we'll just give it about 10 more seconds. Half of us are in our startups, meaning pre-revenue or pre-venture. And so depending on the product, you're going to want to pay more attention to certain products, because there are, that's where you qualify, and there are others where you will not be able to qualify. Okay. Also, I'm going to stop that poll right here. And there is a second question that we want to answer. And this will allow for us to ascertain just where you are in terms of your revenues. Okay. And so I'm going to go ahead and launch that poll as well, so we can have a good answer there on that one. All right. 1 moment. All right, as for the revenue, you should see the revenue question pop up in front of you here, okay? There are 5 different categories: less than 50K, between 100 and 150, 150 to 250, 250 to 500, and then over $500,000 in revenue, okay? That gives us a really good idea in terms of where you may start to look for these alternative business funding options, okay? So it seems as though for those of us who answered on this particular poll here, we are all below 50K. No problem, not at all. This is a wonderful seminar, or rather workshop, for you to join in on, of course, because this is where you're going to find most of the available options to you as a business owner who has limited revenues. And so you have to think outside of the box in order to source the capital that will be needed for your company. Okay, so let's go ahead and move forward from here. 1 second. Okay, and we are off. All right. All right, so first, of course, this is coming to you live from Wacif. We are a CDFI, that is a community developmental financial institution. And our mission is promoting equity and economic opportunity in underserved neighborhoods in the Washington, D.C. region. And we've been doing that since 1987. You can see those old pictures of Washington, D.C. there. Of course, it looks quite different now. Moving right along, we have three strategic pillars: inclusive entrepreneurship, community wealth building, and equitable economic development. And so as we move along throughout this process, I want to be very clear. We have many folks that contact us on a daily, weekly, monthly basis. And I would say that the overwhelming majority of people have what we call an access to capital driven request. And so it's important to understand what you qualify for and what you should look for, because knowing the product matrix or atmosphere out there is really crucial to you understanding where to spend your time. And also taking that word timing is going to be of the most importance when you apply for certain products. At certain points in time, you will be an ideal candidate for approval for a certain type of product. And for others, the lender or the partner, the capital partner, will not be willing to look your way because it just doesn't make sense for their business model to lend to you. Okay, and so we're going to talk about timing and where it makes sense and why it makes sense to go ahead and try to take advantage of certain products, depending upon where you are in the life cycle of the business, depending on what industry you're in your business, and depending on your revenues. So let's take a look here, and we're going to move forward here. But first, we're going to do a couple of quick explanations. What exactly will we cover today? Okay, and I want to point out there's a difference here between personal and your business credit products. And some of these products that we're going to cover today actually deal with both sides of the equation, meaning if you have a lender who's willing to lend to your company, they will want to tie it back to your social security number, to you personally, to make you personally liable. You will be what's called the primary guarantor for that product. And that's okay. Of course, when you're starting out, that's really where you are going to have to be. Because of course, the most important metric or data point for a lender to identify is, do you have the ability to repay the funds? Okay, in other words, do you have the ability to repay? And if you do not have the ability to repay, then it doesn't make sense for the lender to extend the capital to you. However, on your personal side, if you have another job, if you have income from some other source, some other means that isn't being generated by your company, by your business, then hey, that's great, because now it opens you up to a lot of other different types of approvals that aren't necessarily offered at, say, your traditional bank or your traditional commercial lending companies in the space out here in the economy at the current point in time. Okay, so with your personal credit products, of course, they are tied directly to your social security number. You are the responsible party. They will be based on your personal income. And the best thing about them, a lot of times we'll cover some of these, are that they will give you lower rates and more flexible terms. And why is that? The reason is because people are more likely to pay debts that tie back to them personally than they are commercially. And why is that? Because, of course, if you have bad credit, it may affect your ability to get a job. It may affect your ability to rent an apartment. It may affect your ability to buy a home. There are a host of things that having bad personal credit can do to you. And by all means, we want to make sure that we keep our person intact. However, if we have commercial products to tie directly to our companies and something happens to our companies, they go into default, they become insolvent, they can't pay their debts, people will wash their hands of it and walk away because of course they have life outside of the company. And so therefore it's more risky to lend to a business as opposed to lending to a person. Now, on the flip side of this, businesses generate way more money and revenue than individuals. And so, of course, the amounts that can be borrowed by your company will far exceed what you can borrow personally. Okay, moving right along. Now, business credit is going to be the credit that you obtain in the business's name. We have another seminar entirely on how to effectively build business credit. Okay, and we're going to touch on that briefly today, but we're more or less just going to talk about the products themselves and what you should pay attention to. So please make sure you have a pen and pad to kind of write down some notes, questions. Though we cannot recommend specific vendors per se or banks, lending institutions to go to, Google is your best friend, as we call it in my household, the Google machine with the children, right? Because Google's what pops up when you first click on the internet. Take these terms that you see here today and simply Google them. Remember the folks whom you see listed when your Google searches at the top, where you see ad right underneath their tagline. They are the people who are advertising and actively trying to get business. And so they may be the most eager and have the most flexible products for you to apply for and be approved, because they're spending money to advertise and they have to get that ROI, meaning they have to get that return on investment, dollars out the door, capital deployed, because that's how they earn revenue as a lender. So when you take these terms down, Google them, always look at least 3 different lenders to apply to for whatever product it is that you're interested in. Okay. Now, with business credit, the profile exists all unto itself. We're going to talk about that briefly. And with an established credit profile and score, the business will then qualify for greater credit. And you'll see that the opportunities for you out there with your companies are going to far exceed what you could ever do personally. Moving right along. Now, just to draw a bit of a contrast between the two, personal versus business credit, you can see on both sides of here. With one, there's a FICO under your personal or your beacon score, your credit score. We call it FICO, industry language. And then, of course, the scores range from 350 to 850. The credit score is determined. We also have where you'll see on both sides the same thing that's reflected here. Insurance rates, interest rates. There are 3 major credit bureaus with your personal credit. And of course, everything is tracked by your social security number. Now, there are consumer protection laws. And so you'll find with certain commercial lending products that we'll cover today, you will have, if you are a sole proprietor or you do not have, depending on how the company is formed and operated, certain products you may not qualify for, because with certain lenders, the rates may be higher or may be structured in a way that if your company is really nothing more than just yourself, then technically what they're participating in is personal lending, and then of course, or consumer lending, and they are then put under a different set of laws with regard to the Consumer Financial Protection Agency and everything else. So be careful about how you organize your companies. Please, if you can, form at least an LLC and have a separation and with regard to liability between yourself and the business. Just gives you way more options out there. Now, if your business credit profile, your Paydex or IntelliScore, we're talking, that's going to be something with regard to Dun & Bradstreet. There's a different scoring system that I urge you to, of course, educate yourself on, and also get a profile or order your profile to make sure you know what's out there on you and know how to manipulate that and what to look out for in terms of building your commercial credit profile. All right. Now, just as a quick graphic here in front of you, you can see personal, Equifax, Experian, TransUnion. With business, it's Equifax. Experian has a hybrid product that's going to combine both your personal and your business credit score. Experian has the dominant market share out there with regard to what lenders review in order to approve your business for financing. And then there's Dun & Bradstreet. All right. The other information here we've covered. I do want to, however, point out to you that both late and early payments are reported with your business credit score. So if your company is doing business with someone and they have you on file, and we'll talk about that here, be sure that they are reporting on you correctly, and make sure they're reporting when you're paying early, because that will count for you versus just paying at the deadline or at the date that it's due. Okay, we'll talk about those net 30 terms coming up here. Moving right along. Yes. So again, business credit is going to be in the business's name, and we'll talk about that here with certain products. And since the business qualifies for credit in some cases, there's no personal credit check required for the business owner. I want everybody, please, when you fill out your credit applications for your business, do not list your social security number, okay? Try to get credit in the business's name only if your company generates revenue. If your company doesn't generate any revenue, then of course, there's nothing to approve you on. So in order to get your foot in the door, if you don't have any revenue that's being generated from the company, you're going to have to put your social security number and your personal information on that application, along with your business's information. But if your company is generating revenue, make sure to try to apply with only your company's information first and have it tied back to your business, okay? Moving right along here. Now, let's start off with our first product here that many folks tend to overlook. And in general, when we're talking about these products here, look, this is nothing more than keeping the cash in your bank account, in your pocket, in your mattress, wherever you keep it, keeping your assets intact, meaning your savings accounts, your CDs, your life insurance policies, your 401ks, keeping your relationships intact, meaning not asking other people for money. There are a lot of different scenarios here where you can utilize credit and get very favorable terms where you're able to keep your cash on hand for those expenditures that you otherwise just have no other choice but to spend your money right then and there. So let's talk about trade accounts. And these are trade lines or vendor lines of credit. All right. And vendor lines of credit, they just let you purchase goods from suppliers and vendors and then pay it back later. Generally, it's net 30. Okay. They give you 30 days to pay your bill. And so this is one of, if not one of the only, the best ways to build your personal credit right off the bat. And some of the places that you can check out, of course, are Laughlin and Associates. They're listed right here for you. Quill, Reliable, Uline. We get those huge, thick catalogs in the mail. You know Uline if you've been in business for a while. Crown Office Supplies, Summa Office Supplies, and Granger. Now, with your trade lines, there are a couple of advantages here. You can pay the vendor after you have, of course, purchased the goods. And this is especially useful if you're buying goods that you're going to resell, okay? Or if you're buying materials that you need for a particular, to perform on a particular contract or project. Of course, you can put get the materials or the products on credit, get paid from your customer, and then pay that back. In other words, you have the ramp up funding needed, or some of it at least, to pay for getting through that job initially. You can keep up with the trends in the industry through conversation, because your vendors, of course, are going to always be in touch with you if you owe them money, and we'll talk about that in a second here. Also, you get percentage discounts and rewards for paying your debts on time, and you can keep your business costs down. All right. Now, there are some disadvantages with these types of vendor lines or trade lines. Okay, you will incur penalties if you pay late. Okay, and of course, if you're paying late and if you're incurring penalties, that means the goods actually cost you more. So make sure you pay them on time. Now, you have 30 days. Please make sure to pay them on time. Now, you can damage your credit if you pay them consistently late. Okay, so if you have a couple lates here and there, okay, but always, however you have to do it, with your calendar, with your reminders, however you do it, something automated, make sure you are not consistently late. Now, you can also run into trouble if your business has seasonal lulls. So and if you have to borrow money to pay off your vendor to remain in good standing. So never start down a path where you may have to rob Peter to pay Paul, as they say.
Let's jump in here real quick, Lou, with a question.
Yep, go right ahead.
It says, if I'm a startup and I have not generated any revenue, will the debt obtained for the business show up in my personal desk, or will it just use my personal information as a personal guarantor?
Yep. So if you are a startup company and you don't have any revenue, the only things that you're going to qualify for, and we'll cover them, some of them here today, will be products based on your personal credit. And so therefore, they will show up under your personal credit profile. Now, if we're talking about your vendor lines, okay, those are the ones as a startup that you can qualify for. But when you say you've generated no revenue at all, that's going to make it considerably difficult. However, with those trade lines, with those vendor lines, if you apply for your business, but also list yourself as a personal guarantor on the funds, that will be reported for your under your business credit. But of course, you are personally liable, and that's really what we want to avoid if your interest is to, of course, build your business's credit. Did I answer the question there?
Yes, they did. Yes, you did, Lou.
Okay, great. Okay. All right. So after, and we're moving along in kind of a very methodical way here. So of course, after your company would establish vendor lines or trade lines with the aforementioned, different vendors out there to go to, that's when you step up and get your business credit cards and lines. And very, very briefly, the best place to go right after that is going to be, your Office Depot, Staples, Lowe's. You see them here in front of the screen. Make sure that you reach out to these folks and apply for that business credit. Again, if you don't have the revenue, you're going to have to apply and attach your social to the application. Okay, no problem. You can do it. Most times, this is more about being able to keep your cash in your pocket. And if you're going to have business expenditures where you're going to get the money to pay this back, then of course the ROI is built in. This is only if you're spending that money to put you in a position to perform to make more money. So if you're spending it on a particular job, a particular contract, etc., this is where it makes sense to take on the debt. All right. Now, approval time with these products is generally within 2 to 3 weeks. All right. But the strategy here is for you to get multiple Visa, MasterCard, Amex, and continue increasing those limits. Okay. So that you can have the capital there in case it's needed when you are actually in need. And here's the issue most times with folks that come our way, it's like, you wait until the very, very last minute. Generally speaking, 2 to 3 weeks is the average approval time, but you need to prepare a month in advance. I don't care if you're dealing with a regular business loan, your bank, a CDFI, anybody out there, if that loan has to go up through the chain of command, then of course you need a month to prepare to use those funds. Now, if you don't and you wait until the last minute, that's okay. It's human nature, but understand you will pay. And the products you qualify for at the very last minute that are deployed to you very quickly will have the highest rates. Okay, so keep that in mind. Prepare. All right. Now, moving right along here, equipment leasing. Let's talk about this. A lot of times we have requests for loans, and the reality is you can get a loan, but there are certain disadvantages of loans. And we'll talk about that coming up. But there are certain advantages with leasing the equipment. Primarily, and I'm no accountant, of course, and I want you to also verify and double check this with your accountant here, but there are tax advantages given for leasing your equipment. And they far, in most cases, outweigh what the tax advantages would be if you were to purchase the equipment. Specifically, you can write off the entire amount of the lease payment itself, okay? And that can be expensed within that current tax year. And whereas if it is a loan for the equipment, if you have financed the equipment, the only taxable advantages that you'll have access to will be writing off the interest that you're paying on that business loan, as well as depreciating that asset. And so, of course, that's spaced out over a much longer period of time. And therefore, the net tax benefit for that particular item is less within the current year. So if we're talking about the current year, advantages, leasing far reigns supreme. In most cases, again, check that with your accountant, and it depends on the type of lease that you're going to grab a hold of, okay? Also, with regard to leasing, you're going to be able to have the current equipment. One of the issues when you buy the equipment outright is, of course, you may have a need for it now, but you may not have a need for it 3 years from now. Or what you're using today will be outdated 3-4 years from now. And so now you're stuck with this old equipment, but there are some advantages there too that you can utilize. And there are pros and cons on both sides. The best thing about equipment leasing is it can be used for a new business. Primarily when you're leasing equipment, I don't care if it's cars, copy machines, mailing equipment, you name it, kitchen equipment, is as long as you have good credit and some form of income that they can base your payment on, you are good to go. So it's great for startups and folks who otherwise wouldn't qualify through traditional means if their companies don't have the revenue and the history. All right, now equipment leasing. Most folks, as we have covered here, are allowing for themselves to take advantage of the tax benefits and not having to spend the money out of their pocket when they are considering the acquisition of equipment. And when we get into the actual equipment financing, let's talk about what we're going to be able to do here. Most times we have folks that may contact us and say, hey, I'm expanding. I want to go into a different line of business. I want to diversify my revenue model. I want to take on this. I want to take on that. And for this, I'll need new equipment. Okay. Now, when you finance the equipment, which means to get a loan for that equipment, you are receiving that money upfront to buy and repair. And we'll talk about or lease, because sometimes with a lease, you may, of course, there are certain types of lease where it's lease to own, or you may need the money to put the down payment on the lease itself. But what you're really going to be able to do here is to spread the cost of your purchase. All right. There's no need for additional collateral because that will be the collateral itself for the loan. And what you're doing when you lease equipment, and this should only be used when you're looking to increase your business's future sales, okay, to increase your capacity for current demand that you have in place. Okay. Moving right along. Now, the disadvantages of financing the equipment, of course, is that you will have certain restrictions that can be placed on it. Now, if you are leasing the equipment, you will be held contractually to only using the equipment maybe by a certain meter. If it's a copy machine, for example, not up or over a certain number of copies. And this is how they can kind of make sure that their equipment isn't being overused and ruining the resale value or what they could otherwise do with it after the lease term has expired. Did you have a question, Russell? Didn't know if I heard you ring in there.
Yeah, no. I was clear my throat, but just quickly, this is beyond the scope of this, but it fits into the space of when you and I, we take these conversations or take these engagements with businesses who are, a significant part of our engagement is around financing requests. And a part of that discussion is, not just the financing, but a part of that engagement is, how much and to what extent is a business owner understanding the nature of their revenue, right? How much money is coming in, what's determining that. So a big part of the financing and the ability for the entity, whether it's Wacif or any other, to be comfortable with giving financing resources and lending products to businesses. In addition to that, is really understanding the nature of your business. And a big part of that, once again, is understanding your revenue. Because if the revenue isn't matching up in terms of what you're bringing in and what even your projections might be, that's going to make the entity a little bit wary in terms of you being able to really be comfortable with the organization of comfortable lending. Because if we're going to lend and finance, but then you don't understand the business, that becomes a challenge. So once again, we have other workshops, and I'm actually leading one next month that begins to look at the overall business model and revenue structure as a part of that. But once again, that's beyond that. But that's also a part of that when people are going for financing, a part of that equation is, Luke and I can speak to this also. People come in, well, please give us some money. But then we're having that broader conversation around the real well-being and the sustainability and the viability of the business. That becomes a part of the conversation as well. So once again, that is beyond the scope of this particular workshop, but we want to include that because that is a part of the financing conversation and our decision to then engage with businesses to give them these products. So I just wanted to quickly throw that in there real quick, Lou.
Yep, thank you, Rasul. And of course, with all financing products, the most important part is to understand why you're going to take out a loan or create the debt obligation. And it should only be to ensure a future revenue stream. In other words, if I have a new contract that's signed and sealed, if I have a new purchase order that's signed, then that's when I want to go and take on that new debt, because I know that the revenue is going to be there in order for me to pay it. It's net positive, as we say. Okay. All right. I think we're good here on the equipment financing here. Let's move right along. All right. Next up. All right. So let's talk about now if we have our equipment. It's leasing. The financing and leasing is perfect if you want to avoid those cash expenditures and gain the tax advantages. But the other thing that many people miss out on is how to leverage existing equipment that you already own to qualify for funding. So sometimes we have people that call and say, hey, I have equipment that can be used as collateral. Most times we're not really in that space, but there are specific lenders who are in that space to help you leverage any equipment that you have in your fingertips. Now, most times when you are a startup and you have a wad of cash, you may go out and spend money on something that you just shouldn't have. And you realize it later, I shouldn't have bought this big old thing. Now I have this big $30,000 piece of equipment. What do I do with it? I'm not even using it right now. I need the money for something else. I wish I hadn't have done that. Okay. Now let's take a look here. If when you do that, we actually have what's called a equipment sale leaseback. Okay. Now, when you have a sale leaseback, what exactly takes place? And hold with me while my screen adjusts here. Give me one quick second. All right. So, well, I can go ahead and tell you. So an equipment sale leaseback is when you actually own the equipment outright. Okay. There are lenders that will allow for you to take that equipment. You will, on paper, sign it over to them. And at that point, they will, in effect, lease it back to you, and they'll give you a large lump sum of cash. Okay, now, why does this make sense? And, some people may ask, why would I do something like that? Well, here's the thing, right? If you have the need for cash, and most times with a lease, that you can have a buyout, so to speak, you may need this money right now, today. Okay. And what happens is, if you're able to, this large asset on file, most lenders are not going to be able to use that as collateral. But if you do a quick search in Google for sale-leaseback, equipment sale-leaseback, you will have multiple vendors that will pop up, and they will be willing to give you, depending on the value of your equipment, a lump sum of cash. And then you, of course, will make monthly payments to them, and it will be in the form of a lease. At least that's what it's called contractually. Okay, so that's how you're able to leverage an asset that you already have on file and get a lump sum of cash, and then make monthly payments after that. Now, what happens with that product? Let's say that you want to get out of the lease. It's no problem. You can just buy out the lease. Typically, they may have like a $1 buyout clause or something like that. That's typical or standard within the sale leaseback industry. Okay. Now, when we're talking about, excuse me, just get through here. All right. So, all right. Next up, let's talk about vehicle wrap financing. Now, a lot of us, if we're just starting out here, and this is especially crucial for those who are startups, they don't have any revenue. And of course, what that means is you may not have the cash to advertise. It's very expensive to take on cold call marketing campaigns, to hire people, to hire an agency to cold call for you. It's very expensive for you to pay for radio ads. You have to buy very large packages. It's very expensive for you to pay for TV ads. You have to buy very large packages. It's very expensive for you to pay for space on a billboard. Advertising costs a lot of money, but something that most folks don't realize they can use is a vehicle wrap. Now, if you have a car, Great. This is your billboard. And if you don't have the cash to put up to get it wrapped, because wraps can cost, between $2,000 to $5,000, okay, you can get a loan to pay for this for you. And believe me, even if you're not driving the car, you can, of course, if you have certain high traffic areas that you want to be in, hey, you can park it there if you need to. If there's someone who owns a business at a very busy intersection of some sort, you may ask them, hey, is it okay if I park here? I'm trying to get my business off the ground. Do you mind? But as long as you're driving around or anywhere that you're driving, make sure that you're advertising your company right then and there. Okay. And so that can work on all vehicles. You can have it wrapped from top to bottom, even the roof if you'd like to. Okay. Now, what I want to point out for you here with vehicle wrap financing is a couple of things, however. You may run into the issue of, do not make it campaign specific. If you're selling or promoting one thing at a certain point in time, make sure that's not a part of your wrap. The wrap is there to stay, and it's expensive. Well, not very expensive, but there's a cost to have it removed for you. It can be between $500 to $1,000, okay, to have it removed properly and to make sure your car is, the underlying coat of paint is preserved, or it may have to be repainted. But also make sure that whatever you have on that wrap is going to stay intact, meaning your logo, your company name, your telephone number, all of these things you're going to want to make sure that that's what you want. Your iron on it. A lot of folks want to go back and use a different 800 number or change their company name or change their logo. And, everything has to agree. When I see your wrap and I Google you online, because that's what most people do when they search for your company, I want to see the same logo that I saw on your car on your website. I want to see the same phone number on your car on your website. And most folks are going to look you up online first before ever reaching out to you. So make sure that you're pretty ironclad on how you want to move forward in your business and how you're branding before taking on a wrapped vehicle. Okay. All right. Next up. All right. Wrap financing here, of course, just going over here, the same with any other type of financing. Loans, okay, they can go up to $50K if you have a very, very large, huge truck or van, depending on the wrap that you want. The tax advantages are, of course, with the loan itself, you're able to write off that interest, and the approvals are very quick. All right, here we go. Commercial signage financing. If you have either a brick and mortar location, or if you can contract with somebody else's high traffic location, you can get financing for the signage that you'll place at that location. And most times the actual vendors or companies that offer the signage, such as say like Fast Signs or some of your other franchise locations out there that create the pylon, the pole, the neon signs, they have a financing option for you right there at the point of sale. So if you want to walk in and say to them, hey, I want to get a sign. I just leased this location for my spa. The signage is horrible. I want something, and of course, with the approval of the landlord there, I want something big and fantastic and bold and colorful. Well, great. And they're going to tell you, well, the sign that you want costs $10,000. You're going to go, oh my God, $10,000. I never knew it cost this much. And the other thing is, well, there is financing available. And most folks, if they know the cost, they never really make the inquiry. But what I'm telling you is you can make the inquiry, inquire about the cost and the financing involved, because there's a direct correlation between how many people see your sign and walk into your location or call you or go on your website, and the attractiveness of what they've been able to view, and they make a judgment call on your company right then and there. So it's very important. Signage is very crucial. A lot of folks, if they see your sign and it doesn't look good enough, they'll choose not to do business with you, not to walk into your location, not to make that phone call, or not to go on your website. And again, it matters a lot. All right, next up, we have a securities-based line of credit. In the industry, we call this an SBL. Now, for some of us, this makes sense. And if it doesn't make sense for you in particular, oftentimes we have to look within our networks. May it be your grandmother, grandfather, mother, father, uncle, aunt, sister, brother, cousin that has a portfolio of stocks. They can get what's called a securities-based line of credit. Or if you have a portfolio of stocks, you can get a securities-based line of credit. This will have to come through your particular brokerage house, whomever you trade with, or whoever holds your stock portfolio. Not something that's within a retirement plan, just stocks that you have purchased with, your own funds, after-tax funds. You are able to get a line of credit for as high as 90% on whatever you have within that portfolio. Generally speaking, however, you will have to have at least $100,000 in that portfolio. That's kind of the industry standard in terms of what all they want you to have to feel comfortable with it. And of course, there are certain, the advantage here is that with this type of product, the rates are extremely low. You'll see, rates as low as 1.6%. That's because it's fully collateralized, right? It's guaranteed. The funds are already there. If you don't pay, they'll just take your stocks, right? So there's such a low interest rate there, okay? And there's really no documentation required. You just simply apply and fill out the application to take a loan out against your money, and they're able to get that back to you very quickly. It's a very fast process. One of the best things about this is the rate. And so you're not going to find a 1.6% interest rate anywhere. Even if you have cash in the bank and take a secured loan against cash in the bank or cash secured credit card, nothing's going to beat the rate on an SBL. Okay. Also, though, keep in mind, if there are market fluctuations and the prices of stocks tumble, you may be required to make a deposit in the bank, and that's just to cure the position between how much you have outstanding and the value of your stock portfolio at that time. Okay. All right, moving right along. Let's talk about 401k financing. What I want to do here, one second here. There's a way to leverage what's in your 401ks, and most people never think about this, or it kind of takes someone to kind of bring this up to you. But many people, even if we're talking about stocks, they liquidate their stock positions, and use their money. Never do that. Always take a loan if you can, and only take a loan if you have a surefire, or nothing surefire, but you're almost certain that you're doing this because you have the money coming in. Not that you hope, but there's something signed saying, I can get this done, or you have a really good idea or expectation it's going to work out for you. Okay. And so what we're going to talk about here are a couple of different ways to use funds within your IRAs. Okay. Generally, and we're going to talk about the ROBS plan and a 401k loan. In less than 4 weeks, you can gain more control over the performance of your assets, and you can get the working capital you need for your business's growth. Okay. Now, first, let's talk about ROBS. Interesting play on words, because if you do this incorrectly, you will rob yourself. Okay. I absolutely guarantee you. As a matter of fact, don't even try to do this yourself. They have a specialist that work with you so that you can navigate this process correctly with the IRS, because if you do it the wrong way, you're going to pay penalties. Okay. And if you have a 401k, never just take the money out of the 401k. It's the worst thing ever. There's an early withdrawal penalty. Then you're going to pay taxes on it as far as it being considered a part of your income. Never, ever just take the money out of the 401k if you can. Either do a rollover. It's called rollovers for business startups. Okay. Now, according to the IRS, you're able to do this. You can take out or take these funds, roll it over, okay, into your retirement, out of your retirement plan, and use the working capital, okay, to buy, in other words, like stock ownership in the particular company that you are starting up, okay. This is a tax-free event, and it's not technically a loan, but if you don't pay yourself back, then oh well, there's no penalty for it. And of course, you can see that has huge advantages over literally just taking the money out of your 401k and liquidating your positions in the market. Okay. Now, the other option here that we'll have is with the 401k lending. If you have a 401k right now, very simply, you can call whomever your 401k is housed with, and they will allow for you to take a loan against your 401k. Wonderful rates that are given. The rates are great. Why? Because the funds are already there. The collateral is already there in the bank, right? And of course, if you don't pay, okay, I mean, you're robbing yourself. It's just, what it is, right? What you want to do is make sure that if you're going to borrow from your 401k, that you have a very, very good reason to do so. And even more specifically, or rather, it's more important than using other assets. This is your nest egg. This is your retirement. If you mess this up, what are you going to do? And so I caution you, like every other type of debt instrument, but especially with something dealing with your 401k, exhaust all other options first, unless you have something that you think is pretty much surefire. I would say go with it. All right, moving right along. Let's talk about revenue lending. Now, I think that from what I saw, most people on the line with us today are startups, or you, of course, have revenues that don't exceed 50K right now, and that's okay. One of the things you'll run into an issue with when you start to generate revenue in your businesses is being able to qualify for funding with the bank. You'll say, hey, and I've been making money for several months now, or 6 months or a year. I'm going to go to the bank and ask for a loan, and everything should work out smoothly. Wrong. Okay. I pretty much guarantee you it's not going to happen. Okay. But based on your revenue, there are products out there. Okay. And essentially, the word that I used here is royalty on the revenues, because there is a percentage of gross that can be used for repayment on certain loans. And that can come in the form of what we're going to call merchant cash advances. And there's also revenue-based, we'll call it deposit-based funding that's available to you. All right, so we'll move over to our next screen. So merchant cash advances, MCAs. You've seen them. If you type in business loan in Google, they're going to pop up everywhere. Quite possibly one of the most expensive products out there, the worst terms, the shortest terms. But, and you may say to yourself, who on earth would take a loan like this? I can't see, why would I pay 30%, 35% on some money, right? And so if you choose this type of option, just make sure that it's worth every penny. In other words, if you need 10,000 to sell a product or service for 20,000, well, you're going to make 10,000 in profit also. So the margin's there for you, right? But sometimes it's not just dollars and cents, right? The only thing I can think about, let's say that you're facing being evicted from your home or your apartment or whatever, right? And well, who would take a title loan on their car? I mean, when you ride by these places, you may say to yourself, I would never do that. And the rates are crazy, and who wants to run the risk of their vehicle being repossessed? But I mean, the reality is it worth getting kicked out of your home? I mean, having your stuff on the curb and your kids having to go into a different school district and all the other problems that come along with it. So, there are loans for everybody in different situations. Or think about the merchant, the business owner who has to make payroll. Who wants to take on a huge interest rate just to make payroll? Well, there's no profit involved in that situation per se, but what about the irreparable damage that's caused if you don't make payroll? You're going to find out just how much your employees love you if you pay them late. I guarantee you, they won't be back tomorrow. Okay. So sometimes it's not just about the dollars and cents. You have to think about it and make sure that it makes sense for your business and what you're trying to get accomplished. Okay. All right. Now, generally MCAs, merchant cash advances, go up to about 250 max. They are based on your credit card sales. Okay. How are they calculated? So you have a credit card processor, ABC credit card processing company, and they're going to have a separate credit card processing statement So if you have swiped $10,000 in sales for the month, it's going to go to your credit card processor. They have a very small fee they take out, and the rest it's going to go to your bank account, the settlement account that you've designated. An MCA lender is going to take a look at that particular credit card statement, and they're going to say, you bring in 10,000 a month. Okay, great. And so they're generally going to say, well, that means you make 12,000 on average, $120,000 for the year. They may go up to about 10% of that number, which would mean 12,000 bucks would be the most you qualify for a loan with an MCA provider. But if you think about it, if you're making $120,000 a year in your business, generally speaking, the margins there in terms of what your net profit may be, it may or may not make sense. Sometimes someone that makes $120,000 is walking away with $100,000 because they don't really have any overhead, or they may be walking away with $20,000 because they had to pay for a bunch of, services and equipment or people or what have you. And so it has to make sense for you in your particular situation. Moving right along. Also, when you're starting out, and especially if you're contractually based, whether you're B2B, meaning you are business to business, you're doing business with other businesses out there, or if you are B2G, meaning you're doing business with government contracts out there, you have to take a look at how you're invoicing and how your customer is paying you. Is your customer, are they going to pay you within 30 days, within 45 days, within 60 days? Sometimes that wait can run you out of business. We don't want you to go out of business, okay? And so right after you invoice, there are products available to you to pay you 24 hours after you invoice your customer, which means if I'm contracting with ABC company and I've performed $20,000 worth of work this month, I invoice them for $20,000. I need that $20,000 to pay for my office space, to pay my employees, to pay other expenses. It costs the things that cost me to actually take on this new contract, this new job. If ABC company waits 45 days to pay me, now that's 1 month plus another month plus 15 days I've waited to be paid. And so this is where invoice factoring and financing comes in. With invoice factoring, you're going to have a lender to give you 80%, which if it's $20,000, that's $16,000, right? The day after you invoice. And then you're going to get the rest after your customer actually pays you minus the lender's fee. So in that example, I've worked for a month. I invoice ABC company for $20,000. The lender is going to give me $16,000 right away. And then I have to wait the other 30 to 45 days. When ABC company finally pays, they're going to pay it to my lender. My lender's going to take out their fee and give me the rest of the money. But I was able to make my overhead, pay for my office space, pay my employees, et cetera, et cetera. Now, invoice financing is slightly different. Invoice financing, and remember with invoice factoring, I said that ABC company paid your lender because the lender has to get the money first. With invoice financing, the lender does not receive the payment from your customer. Invoice financing is a little harder to qualify for. The rate's a little bit different, but you don't have to involve your customer in paying your lender directly. You control everything with invoice financing. Again, invoice factoring and invoice financing, check both of those out if your business is contractually based, meaning you do business to business with other companies, or business to government if you have government contracts. Moving right along. I didn't know if we had any questions there, Rasul, on that product.
No, we're good so far.
All right, cool. All right, so business revenue lending. To piggyback on your merchant cash advances and your deposit-based funding products out there, instead of looking at your credit card sales, lenders will also look at your deposits in the bank and your bank statement. They're going to back out all of the transfers. They're going to back out all of the, kind of just cash deposits in the bank. but they're going to look at the pure revenue that's coming through your bank account on a daily basis or on a monthly basis, and they can extend funding to you that way as well. And so some of your larger companies out there, if you type in receivables financing or something like that, you'll see that they're available. Typically, you have to only be in business for 6 months. That's it, okay? You only have to bring in at least $10,000 or $5,000 a month. That's it. And so if you're just starting out, this is a resource. It's an expensive resource, comparatively speaking, but it is a resource for you to grab a hold of the capital that you may need to start new jobs, buy equipment, or take on those expenditures to put you in a better position to make more money. All right, moving right along here. AR, accounts receivable factoring and purchase order financing. Sometimes, let's say if you're a manufacturer of goods, or if foods or some type of product or clothing or something that's going to go into a large store, or if you have a large order come in from a business customer or for a government customer, that's a purchase order. And that purchase order, you can take it and use it to receive funding right away. So if you have someone that orders $100,000 worth of products for you, and you know it's going to cost $60,000 to make it, thus your profit would be $40,000, but you don't have the $60,000 it takes to purchase the materials or whatever you need, you would simply take that purchase order, and of course you'll want to align your strategy, the way that you're operating to go after these larger purchase orders, because you know there's financing out there for you. But you can take that purchase order, and there are lenders specifically oriented towards funding purchase order loans against purchase orders. And so what will happen is, of course, you will receive a percentage of that purchase order. In this example, I said, up to $100,000, right? That means, hey, if you only need 60, you can say, hey, I have a purchase order for $100,000. I need $60,000. You will receive that $60,000. And of course, there is a fee on the money. But if you have a nice healthy margin, make sure you're still going to be profitable. That's a way for you to move forward. So the same can be done with your outstanding accounts receivables. Okay. There is accounts receivable factoring, and it works similarly to your purchase order financing, whereby they're going to take your current roll of accounts receivables. They're going to check out, and accounts receivables are just a bunch of other customers who owe you money. Okay. And certain lenders will say, okay, you have 10 customers that owe you money. They're going to check out all of their business credit profiles, because your business credit profile is public. They're going to make sure these are some good guys, okay? And they're going to advance you funds based on your customers. And again, up to about 80% of whatever your outstanding invoices are at that point in time. Great products if you have a cash crunch, or if you're looking to expand your business and take on larger orders, larger customers, and you don't have the cash to do so, okay? The other thing that you can do is check out that purchase order lender or accounts receivable lender prior to going after new business or taking on new customers. You can have them check out your customer and tell you whether or not they'll finance a purchase order from this particular company before you even enter into business with them. And that way, you know that as soon as you get that purchase order, you have someone that's going to give you money in advance on that particular expected revenue stream. Okay. All right, moving right along here. Covered that one essentially. All right. Let me go back. So the purchase orders we've covered. All right, now let's talk about auto vehicle leasing. Many people out here have needs for vehicles, work vans, passenger cars. I don't care if it's if you're in janitorial services, a residential cleaning, your workers need cars to get around to the homes. If you're transporting passengers, you're going to need a van with certain specifics. If you are renting cars to Uber drivers, you're going to have cars or vehicles that you can use. And of course, leasing those vehicles are going to come with significant advantages with regard to the model, the year, the upkeep of the vehicle, as well as you can obtain multiple leases at the same time. And one of the best things about vehicle leases is that they can be obtained utilizing the business credit only. And so no one is trying to tie it back to you personally. Just a certain caveat out there with regard to auto vehicle leasing. A special area is carved out for leasing the vehicle to businesses only. As long as you can show the revenue or the or if you have the history to qualify. All right. Lastly, let's talk about something that most folks tend to overlook, and that is their largest asset. Your largest asset is going to be your home, okay? If you do a quick Google search out there, home equity loans, home equity line of credit, HELOC is what we call it in the industry, all right? To do a quick calculation on this, let's just say that you have a home that's worth $100,000 and you have a mortgage for $30,000 or $40,000. So you owe $40,000 on a home and it's worth $100,000. A lender will typically go up to your bank, for example, up to 80, let's say 85% of the value of the home. So in this case, if the home is worth $100,000, they'll look at up to $85,000, okay? And then they will back out what you owe on the home currently. So if you owe $40,000, they'll take that $40,000 away from the $85,000. And though you have $60,000 of equity in the house, the lender will give you a loan or line of credit up to $45,000, okay? And this is one of the best products you can check out for funding your business ventures because it's secured. The loan will be amortized over many years, most times 10, 15 years. And think about that. Your average business loan is only going to go between 4 to 7 years, and the rate's going to be, in the high, maybe low teens or, 7, 8, 9, all the way up to 7 to 20, right? But your home equity loan is typically going to be, below 7 or 8. So at least right now, at least. And it's stretched out over such a long period of time that the debt service is low. The monthly payment is low every month, okay? And so it's important to just check that out, because if you have either yourself or someone that you know or a business partner who has a home that has equity in it, it is very easy, as long as they have revenue. It can be from their day job, or if they are self-employed, just revenue that can be tracked or traced back to them. They can walk into any bank and say, hey, I would like to take out a home equity line of credit. I would say a home equity line of credit is the most advantageous product because it works just like any other revolving line of credit. It can be used over and over again, and the interest is tax deductible, okay? Or if you have a specific expenditure or outlay of cash, I would take the loan itself, okay? And so that will sum up our products for today. Thank you for joining us. If you have any questions, I'll be happy to field them now.
Just waiting, Lou. No questions have popped up, so maybe give folks a couple more minutes. If not, put a bow and a button on it back. Wait a couple minutes here.
Okay, I see someone has their hand raised. I think it's Cheryl. Do you see that on your end, Russell? Since there's no one else, I'm just gonna, I guess we can allow.
If you see it, go ahead. I don't see it from mine.
Cheryl, I'm just gonna click and say allow to talk here. Go ahead, Cheryl.
Yeah, the question I have for you, can you post your contact information?
My contact information?
Yes.
Sure. We'll put that in the chat, okay?
Okay, thank you.
No problem. Let's see, okay. And do we have any other questions?
Yeah, there's one coming up here, Lou. It says, I thought you could get a business credit card with your EIN as a startup.
Yeah, so the term startup has many different definitions. If you mean startup, And I guess we can ask, of course, if it's startup, meaning you have been in business for less than 2 years, or are you a startup, meaning pre-revenue, pre-concept, you have no way of showing that you would be able to pay back the funds. So, and there also are there's one caveat here. On a business credit card, you can be a primary guarantor, which means the credit card isn't solely based on what you bring in through the company. Okay, the credit card then is being based on you personally. And so the idea with establishing a business credit card is to have it established for the business, because that's where we're looking to grow our credit profile in terms of being able to qualify for other products down the road or in the future. If you are going to use your personal information, you may as well just get a personal credit card. It's a lot easier to qualify for, and you probably get a larger amount of money. So, depending upon how you define startup, yes, you can qualify, and it depends on whether or not you want to apply for that credit card using your personal information along with your business information, or just your business information alone.
We got another question follow-up. Do you run the risk of piercing the corporate veil if you use your personal information for the business credit account?
All right, so piercing the corporate veil is a term for all the folks out there. If you have a separation of liability between the company and yourself, if there is any type of action against you, you usually want to be able to go to court and say, hey, listen, I am totally separate from the business. If this person or this company has a claim against me, then they can go after the assets in my company, but they can't touch me personally. And so in order to pierce the corporate veil, there has to be a history where you have been financially negligent and what we call commingling, funds between the business and yourself. So as long as you are making sure that all of your expenditures out of your company's bank account are for business expenses, legitimate business expenses. All of your expenditures on your company credit card are for legitimate business expenses, and then you should have nothing to worry about. Piercing the corporate veil shouldn't be an issue to you, of course, if that's not taking place. Hopefully I answered that question for him.
Yeah, if you need clarification, please feel free to restate, but I think you answered the question, Lou.
Okay, wonderful. All right, folks, any other questions out there about any of the products that we've covered today?
Going once, going twice. I think that's a wrap, Lou. I think no more folks. We're getting thank yous. So if you want to do the wrap up and
hey, I want to thank everybody for joining in with us today. Listen, this workshop was given so that we understand what our options are out there. Okay, you should only spend your time applying for products where you've done some research on the front end to know what's going to be a good fit for you and where you know the qualification criteria involved, because that allows for you to prepare. It's one thing for you to just walk in and go, hey, give me a loan. It's another for you to have a conversation with someone and say, hey, what are you looking for? What credit score do you need from me? What income would you like to see? What are the red flags with regard to my business credit profile or my personal credit profile that will cause me to be declined for a loan here? For certain lenders that are revenue-based, what do you need to see as a minimum income requirement from me? Minimum deposits, minimum annual revenue, minimum credit score. How many deposits in my bank account must you see each year? How many years must I have been in business? You want to know all these things before spending your time applying for products out there. And then most importantly, if you don't have it on the business side as of yet, because everybody has to start somewhere, then take your time to explore the products on the personal side and really understand, okay, well, listen, I'm going to do this first But once I get going, where else am I going to look for capital immediately? And so if you do that, you'll put yourselves in a great position. You may want to go through vendor credit lines, company credit cards. If you're contractually based, be lined up for invoice factoring or transition over into invoice financing. All of these things will be available to you with preparation and investigation on the front end. So I thank you, everybody. I don't think we have any other questions here. I do see.
Yeah, we got one. Yeah, one more general question. It says, what other services does Wacif offer for aspiring business owners? You want me to take that, Lou?
Yep, go right ahead, Rasul.
Yeah, in addition to other financing, support and resources Lou has just spoken to a number of degrees, we also offer business advisory services. As I had mentioned previously, probably about 30 minutes into the workshop, that businesses, before obviously getting financing or simultaneously, also need to be in a position where they're actually building a viable business. And so that runs the gamut from what are your operations looking like to your marketing plan or marketing strategy, in terms of your revenue, what does that look like? Where your customer base coming from? Everything from A to Z, even dealing with HR. If you're growing, obviously you're needing additional resources from personnel. You want to hire, are you a business that you want to contract? Are you looking to source human capital in that regards? We might be able to tap into our ecosystem, get folks to assist with that. So we knew a number of engagements and service support with respect to, once again, helping businesses to be able to thrive across the board. So like I said, at any time, my email address I just included in the chat along with Lou's. Once again, from financing to just really business strategy, engagement and development and growth, we can provide those resources. And if him or I don't have that, one of the things that Wacif also prides itself on, we have a pretty robust ecosystem. For instance, if you're looking specifically for accounting support, all right, we don't do that in-house, obviously, but we also have some referrals, companies and organizations that we can work with, that we can refer you to. Once again, that can be from accounting to website design to a number of other social media agencies if you're looking for the digital engagement as well. So those are just, once again, a number of the sources and information that we can put you in contact with or support you. Once again, if there's anything beyond that, feel free to email us and we can definitely have a much more in-depth conversation in terms of how we can kind of get you up and running or keep you up and running, so to speak.
Indeed, indeed, indeed. All right, well, if it's nothing else, of course, we thank you everyone for joining in with us today. We should have a copy of the presentation within a day or so, just going back in here and making sure that it's applicable to the audience, of course, for whom we had online with us today. So I thank you, everybody. Enjoy the rest of your Wednesday and the Thanksgiving holiday coming